Hello, everyone. Welcome back. And this is an update on a video that I did last year in 2023. And I think this is a topic that's near and dear to my heart, which is an equity investing style that falls neither in the growth or value bucket, as we typically talk about when it comes to equity style investing. But rather a third bucket, a third type of approach to investing, which is quality-oriented investing. And I believe that this is, in my view, the most important factor when picking stocks, looking for quality businesses. And there's a number of ways to define it. We here at Zacks Professional Services have our own sort of layer that we add on top of other factors that are, generally discussed by those who follow this investment discipline of identifying quality businesses to invest in. So we have our own little flavor of quality, and so I'd love to get into this topic and explain to you what, in our view, are the true drivers of long-term shareholder value. And it doesn't necessarily fall into either bucket of growth or value. But here are those, the definition that we like to adhere to here at Zacks Professional Services. So what is quality? And so we define it across four factors. We look for companies that have high and durable earnings linearity. We look for companies with high and durable earnings growth, high and durable return on invested capital, and high and durable free cash flow conversion. This is the four-legged investment formula that we think provides impeccable long-term results, as long as you buy these companies at a fair price, which in most cases they do trade at fair prices, because we don't necessarily get enamored with exceptional high growth. That's not what we're really aiming for. So when I talk about, in the second bullet point, high and durable earnings growth, it's not necessarily chasing after companies that are showing 40, 50% growth. But really the sweet spot that we found is that, companies that can sustain somewhere between 10 to 15% earnings growth, that is something that can be sustained for a very long period of time. And it can still lead to very strong returns because these companies don't tend to be priced for exceptional growth and therefore have to grow into their valuation. So these are the four aspects of quality that we look for. And companies that meet these criteria over long periods of time tend to be industry leaders with very wide moats that they enjoy. This is how we define quality. In our view, if you can find a company that satisfies all four of these metrics, then you have on your hands a very, very high quality company, especially if you can say with clarity and you can prove with actual results that this company has had earnings linearity that's very high even through recessions. This is the area that we have added that is a little bit unique from what most people talk about when it comes to quality. Earnings linearity means that the company is able to demonstrate high earnings durability, high business durability across different macroeconomic environments. So if a company has high earnings linearity over a 20-year period, for example, which is kind of what we look for, somewhere between 15 to 20 years of high earnings linearity, it means that the company has been battle tested through the inflationary periods of the mid-2000s, the deep recession of the Great Financial Crisis in 2008, 2009, different currency environments between strong dollar and weak dollar, different interest rate environments between high rates and low rates, different periods where economic growth has accelerated or slowed down. If despite all of these various different factors that define the cycle that we're in, the point in the cycle that we're in, if despite all of this volatility on the macro side of things, a company can demonstrate linear earnings growth, then it means that there is something about their business model that is fundamentally durable in nature. These are, companies that have recurring revenue. These are companies that have, customers or clients that need the products and services that these companies provide. These are companies that don't provide nice to haves. They are companies that provide must haves. They are companies that, lead in terms of cost, companies that lead in terms of R&D, companies that lead in terms of, driving ROI for their customers. When there is some value being created and it's a product or service that is needed, then companies tend to have and exhibit high earnings linearity over time. And we'll take a look at what that looks like visually. But linearity is a very, very key bedrock principle that's a part of our overall quality-oriented strategy here. We want to find companies with high business durability over time, despite volatility from the macro side of things, despite strong dollar, weak dollar, despite recession or boom time. Companies that demonstrate high linearity mean that they are unaffected or very, slightly, affected by the macroeconomic business cycle. That's exactly what we like to look for when it comes to defining companies that have high earnings quality. Return on invested capital, another major, principle that we always like to talk about here on these podcasts. This tells you how profitable is the business fundamentally. How capital efficient is the business. Remember, capital allocation is probably the most important principle when it comes to running a business or a company. Is management efficient at deploying dollars of retained capital, retained earnings back into the business to generate that earnings growth? Do they generate earnings that are, high relative to the total amount of invested capital that they need? In other words, ROIC tells you what return are you earning per dollar of capital that you have deployed into your company. That's very important to know because remember, earnings growth, you can show strong earnings growth, you can show strong linearity. But what if your ROIC is low? It means that you're not actually adding value for investors because your ROIC doesn't necessarily exceed your cost of capital. So, for example, you could, have linearity and growth by going on a serial, by basically being a serial acquirer. But what if your ROI on these acquisitions are very poor, right? You're going to show the earnings growth. You're going to have earnings linearity, but you're not necessarily adding value because the investment decisions that you're making are not generating attractive returns on capital that investors require by the cost of capital that we know of. So ROIC is a major part of it. And then lastly, free cash flow conversion. How much of all these earnings are you actually translating into free cash flow? Free cash flow is ultimately the most important metric for all long-term investors because that's what ties to cash on the balance sheet. That's the number that finally ties to cash, whereas earnings are an amalgamation of both accrual accounting as well as cash accounting. But free cash flow is 100% cash accounting. And that's ultimately what matters to investors in the long run because that's what you have. That's how much money, how much cash the business has left over to work with when it comes to doing things like share buybacks and dividends, ultimately, return of capital back to shareholders. So by covering all four of these bases, you really get a complete picture of the quality of a business that you are evaluating. And if you get all four of these checked off in a very strong and convincing manner, then chances are you have picked a company that has long-term economic moats that it is able to ride for the foreseeable future, and therefore significant value creation being driven for shareholders over the long run. So again, we can't ever see into the future with a crystal ball. None of us have that capability, but you can significantly tilt the probability of earning, outsized returns, excess returns, alpha, by focusing on businesses that have demonstrated all four of these metrics over long periods of time. Ideally, number one, you want it over a 17, maybe 18-year period, because that takes you all the way back just prior to the great financial crisis. And then you want, some evidence of earnings growth, at least over the past 5 years, ROIC, at least over the past 5 years, and free cash flow conversion, at least over the past 5 years. If you can find that, then these are what we call high quality businesses. And durability, let's take a little bit of a look and double click on what durability looks like. So when you're looking at companies and evaluating them, durability tells you, or at least durability is defined by, does the company address critical needs? Or is it a company that provides a nice to have? That's the key question that you always want to be asking yourself. Is it a consumer discretionary company? Or is it a consumer staple company, for example? Now, I'm not saying that staples are always better than discretionary. But what I'm saying is that ultimately, we want to make sure that the company does not fall into decay or, become a broken growth company, or, be oversensitive to economic cycles, and therefore require you to know a little bit about where we are in the business cycle and put on your macroeconomic hat on. When you get involved in those types of companies, you're going to have to make a judgment call on where we are in the business cycle, where consumers are, where, incomes are, where wages are, where jobs are. That gets into a little bit of a different area of analysis. Ultimately, companies that provide needs over wants tend to prevail in the long run. So that's why we own companies like Clorox. Clorox provides a needed product, and that need has prevailed now for 100 years. Everybody needs cleaning products, and Clorox is a great brand in the cleaning products industry. So that is a need versus a want, right? So we like to look for companies that provide critical needs to their clients and customers. Or number two, and it doesn't have to be all four of these points here, or all five of these points here, but it should be at least one or two of these five. Does it provide a critically needed service or good? Does it solve a pain point? Does it cut costs for their customers? Does it increase utility? Do they drive ROI to their customers? That is a major, major question you want to be asking when you are assessing earnings linearity, when you're assessing business durability. Do they have a lot of recurring subscription or lease revenue? That's a major, that can give you a significant tip. It can tip you off in that direction. Do they have a lot of recurring revenue? If yes, then that checks off this box. Does it have strong brand value? Do customers identify with the brand? Do they trust the brand? What is the brand value? Brands can have, academic studies published have cited that, brands can withstand the test of time. Brands can endure over time. Things can come and go, but when there is a brand in the minds of consumers, and as long as that company doesn't do anything to tarnish their reputation, brands continue to stick in the minds of customers for long, long periods of time. And that absolutely drives high ROIC, high profitability over the long run. We have seen that especially in consumer staples and even in consumer discretionary, where brands can continue to outlast other sort of generic or non-branded items, even if they have very, very similar use value. So brand value is important. Product experience, customer service, do they lead in any of these categories? And then lastly, strong capital allocation. Are they investing in themselves? Or what is their profitability, right? What is their ROIC? If a company can demonstrate high ROIC for at least 5 years, right, it means that there is something about their business that isn't easily replicable by competitors, right? Because if a company can earn very strong, returns on invested capital for at least 5 years, let's just say. Remember, companies that have very thin moats or indefensible, moats or business models, they may do really well for a year or two, maybe 3 years. But if it looks like they're doing, incredible margins or incredible returns on capital, then what that's going to end up doing is it's going to attract competition. And when competition comes in, then the strength of the moat is going to come into question. So if competition can come in and simply compete away that profitability, then it means that they're not necessarily a high durable company. Okay, so if a company can withstand and sustain high returns on invested capital, let's say in double digits for more than 5 years, because 5 years is typically enough time for a competitor to come in and offer a compelling product. And so if after 5 years or 6 or 7 years, that would be even more compelling, more convincing. If after 5 to 7 years, a company can sustain high ROIC for that long, it means that they're doing something that is not easily replicable by competitors. So these are all areas that you can look at to assess whether there is high business durability and therefore a high conviction that the historical earnings that you see the company deliver can continue into the future. So combined, these factors tell you about a business's ability to continue high performance into the future. So let's take a case study here. Our first company that I'd like to talk about is CGI. CGI is a company that we just added to our flagship model portfolio, the Zacks Earning Certain Proxy. This is our portfolio that I maintain here at Zacks Professional Services, and it's a collection of 76 companies that satisfy these 4 major criteria that I talked about here: linearity, growth, ROIC, free cash flow conversion. So I spend most of my time searching the markets, looking for companies, looking for businesses that satisfy each of these 4 criteria. And the Zacks Earning Certain Proxy is a portfolio of 76 companies that does, in my view, satisfy these 4 major criteria that drive long-term shareholder value. And CGI is a company that we just recently announced that we would be adding to the portfolio. This is an IT consulting and systems integration company. That's at roughly 45% of their total revenue. They also provide managed IT services. That's about 55% of their total revenue. Overall, it's a company that has deep industry and technology expertise. They have sort of specialized in banking, insurance, government, space, manufacturing, retail, transportation, comms, utilities, oil and gas, and life sciences. So it's quite a diversified company. They employ over 10,000 consultants. It's an army of consultants with deep backgrounds in these different industries. And after having and cultivating, decades of experience, this is a company that was founded in 1976. And since then, they have built, decades of experience in these specific industries. They hire consultants that have worked in these respective industries their entire careers, have a very, very deep understanding of how each of these industries work, the nuances involved, the competitors, the competitive landscape. And what they have done is leverage these consultants and their expertise over time to be able to consult and provide critical services to their clients when it comes to setting up the IT backbone that they need. So they deliver the technology systems that companies need in order to be successful in their respective industries. So let's say if you are a upstart insurance company, for example. Not many upstart insurance companies really. But let's say if you are one, you would go to a company like CGI and say, hey, CGI, we are looking to launch an insurance product here in the United States and all, across all 50 states. We need your help in understanding what is needed for doing such a thing. What kind of technology do we need? What kind of infrastructure we need to build? What do we have to do to become successful in this specific industry that we have a product in? CGI would come in and build from scratch. It would design and build your entire technology architecture needed to launch your product in that industry. So that's they're 45% of their business is providing that initial consultation and service and setup. And then managed IT is interesting because it's actually the bigger part of their business by a little bit, but that's really where the earnings linearity and durability come from, because that's where the recurring revenue comes from. Managed IT basically means companies outsource their IT services, their IT setup to a company like CGI to manage remotely or on site or both. So this is especially useful for small and mid-sized businesses where they don't necessarily want to invest in in-house IT support and IT systems maintenance. And so therefore they would go to a company like CGI, many other companies like that, such as Accenture. You might be more familiar with them. But CGI is a great player within this space. We'll look exactly as to why that is, but managed IT is a majority of their revenue, and that's what is highly recurring in nature. And that's why you can see on this next slide, this is the earnings linearity of CGI. Again, this shows business durability over time. It shows business visibility into the future. And you can see here that the company has really evolved really in the last 10 years. If you can see here, there was a lot of, very, very exciting growth. And that's because most of their business at the time was IT consulting. And in IT consulting, there's a little bit of cyclicality involved, especially if you're in between growth curves as you enter new markets and new services and new industries. But as you can see here, that cyclicality really has subsided beginning in 2014. And you can see here that earnings linearity has truly increased and become very, very stable, very resilient over time ever since that year 2014. And that's because that is the inflection point when managed IT became the majority of their revenue versus IT consulting and systems integration. These are obviously highly profitable projects, but they are one-time in nature, so that requires them to continuously build a backlog to replace completed projects. And so there could be, gaps in between. It's not exactly, smooth all the time, right? It can be lumpy. The timing of different contracts can be unpredictable. And so that's why there was a little bit of volatility with that in the early years. But, over the last 10 years, managed IT has become the majority of their business. And that's where the recurring, highly, visible and repeatable revenue comes from. And this is not something that is a nice to have. Every company, every business needs an IT department. And so this is, as long as there are businesses, even if those businesses decline in profitability, this is a fixed cost for them, right? So for CGI, this is a guaranteed source of revenue. As long as the business doesn't, go under, or as long as the business doesn't switch to a competitor, then, this is basically guaranteed revenue for CGI. And this is another important part of it, which is switching costs. I didn't mention that, but, when switching costs are high, that is a source of a economic moat. And that's exactly what CGI has enjoyed really over the past 10 years. So we believe that this is going to continue well into the future. And you can see here, analysts agree. These are the dotted line here are the future earnings projections by the consensus of Wall Street analysts that cover CGI. And you can see just how linear these earnings are into the future. Very, very high durable, business, which means high earnings linearity. Here you can see earnings growth, and I have a regression line on these historical earnings here. As I said before, prior to 2014, they had a little bit of cyclicality because of the nature of timing of contracts from the IT consulting side of the business. But really since 2014, look how close earnings have tracked that linear trend line growth. And that's exactly what we mean by linearity. And then the slope tells you the growth. So that's about an 11% long-term earnings growth rate that the company has maintained. That's their compound annual growth rate. Very strong, especially over a 15-year period. That's exactly the sweet spot we like to look for. Companies that can do that for a long period of time tend to be able to continue to be able to do that for a very long period of time. And that's exactly what has happened. So, between 10 to 15% earnings growth is that sweet spot that we target, and CGI is right inside of that ballpark there. Here's the third, and probably, I always go back and forth as to which of these four principles are most important, but I would say that ROIC, is incrementally the most important thing, because obviously they're all important. But ROIC is probably my favorite metric of these four, because this tells you how efficient is management at deploying the company's capital. Capital allocation is the name of the game, as Jeff Bezos said, many, many years ago, back when he started Amazon. Capital allocation is the number one assignment for management. And if they don't deploy capital efficiently, if they don't deploy capital attractively, then there isn't a whole lot of value creation there isn't a whole lot of value creation for shareholders. And here you can see that ROIC has been very, very strong. Again, in that sweet spot that we like to look for, between 10 to 15%. It can actually be much higher than that as well. We have many companies that are in the 20 to 30% range, but 10 to 15% is a great ballpark to be in for ROIC. This tells you the return that the company is earning on the capital that it deploys, into itself. So right now, the company is generating roughly 14% returns on capital. That means for every dollar that the company retains, they're earning 14 cents of incremental profit, of total profit, I should say. So for every dollar of capital that they have deployed, they earn about 14 cents. That is very good, because most companies have a cost of capital somewhere around 8%. So anything in excess of 8% sustained over a long period of time, compounds quite well over time. And that's exactly what we like to look for, is a widespread between a company's return on invested capital and the weighted average cost of capital. So like I said, most companies have a cost of capital somewhere between 7 to 8%, maybe 9% if it's a risky company. But in this case, they're well above that, comfortably above that at 14%. That's exactly what we like to see. And then free cash flow conversion. I said ROIC is my favorite, but remember, if a company could have great linearity, a company could have great earnings growth, a company could even have great ROIC. But if they have very poor free cash flow conversion, then none of that really matters. Because ultimately we want to see earnings translate into free cash flow. Because if it's not, then that could signal significant accrual accounting issues. That could be a red flag on accounting problems. That would be a red flag on earnings quality. So all of our analysis that we did in the prior 3 points are based on earnings. But again, if a very small percentage of earnings are being actually translated into free cash flow, It could mean significant problems with the quality of the financial reporting that the company does. And here you can see that free cash flow conversion is well above 100%. The benchmark we like to look for, the rule of thumb, is 80%. Some of the best high quality companies typically convert 80% of their net income into free cash flow. So that would be a high quality business, especially if you can do that over time. But, CGI does well in excess of that, over 100%, which is superb. So this, again, is a company that checks off every one of the 4 points that I mentioned here. Very high earnings linearity, especially over the past 10 years as they have switched into a managed IT business. Strong earnings growth that is supportable and sustainable at roughly 10 to 11%. Strong returns on invested capital, especially maintained over time. And free cash flow conversion that is superb and pristine. So again, this checks off all 4 boxes that we like to look for as a company that has, deep, embedded moat in the form of high switching costs and in the form of deep industry expertise, in the form of contract revenue, subscription revenue, things like that. Very, very important, high quality company. The second, example is Gartner. You might have heard of Gartner. This is a company that is actually quite related. It is similar to CGI, but differentiated enough for us to add this company as well to our Zacks Earning Certain proxy. Gartner is a technology consulting services company. Their big aspect, basically where they generate most of their revenue, is deep industry research. This is a consulting company driven by deep research. They publish, research reports. They publish rankings. They publish, all sorts of other, research within technology, all sorts of diversified technology. And this research is relied upon by C-suite executives across industries, but especially anyone who requires and needs technology. They rely on the research that Gartner provides. For example, Gartner provides cybersecurity rankings. So they, provide and look at all of the companies that operate in cybersecurity. They provide rankings. They provide research and, what their true unbiased opinions are on, these different services that are provided, by cybersecurity firms. So if you're a company in need of cybersecurity solutions, but you're unsure which one to pick, you don't have the expertise to be able to understand the deep, technical, aspects of, different services, then you would go to a company like Gartner to get a truly unbiased opinion on who cybersecurity leaders are by category. So Gartner is a trusted brand, a very well-recognized brand that provides unbiased, very, very deep industry and product research that is relied upon by countless individuals as well as businesses. So very, very important there. So, again, while CGI directly assists their clients with IT infrastructure, Gartner focuses much of their resources in publishing deep research. They also, by the way, organize and host prestigious conferences and trade shows. So they host these big conferences, and they invite, if it's a cybersecurity, for example, conference, they'd invite Microsoft and CrowdStrike and Checkpoint and Fortinet and Palo Alto and everyone else too, even smaller players out there. And this is where, industry experts get to meet with these companies, and the companies have an opportunity to present to, very, very important personnel what they're doing and what they're building. So these conferences are a big part of their business, and they generate hundreds of millions of dollars per year on these conferences. So it's a very, very big part of their business too. And these conferences are held just about every year. So this is kind of like if you thought of JD Power, they provide something similar to that, when it comes to technology. This is a very prestigious award and rankings that they issue. Again, it's relied upon by lots of people, industry level people. And they also provide high-level consulting services directly to C-suite executives that leverage their decades of intel and experience. So this is a business that basically exemplifies everything we look for. It's a highly profitable business with a deep moat in the form of both brand value and deep industry expertise and leadership. And they score well across all four criteria. You can see that they have high earnings linearity at 0.92, high and durable ROIC at 25%. That's excellent numbers. And here you can see that linearity and earnings growth together. Again, very, very highly linear earnings growth. As you can see, it really took off well above trend in the post-COVID environment. That's kind of normalizing a little bit now. So there's a little bit of volatility here that was associated with that. But we're kind of looking past that because it overshot so far up above long-term trend. We think that even if it does get back to trend, it doesn't necessarily mean that the company has increasing earnings volatility or decreasing linearity. It just means that we went through a time period in the post-pandemic era that kind of distorted things. So even if we get back to reality here, we're very, very bullish on this long term, because you can see here that the long term supportable, sustainable growth rate that they have maintained over the past 20 years has been almost 19%. So that is an excellent compound growth rate. And you can see that they have had very high earnings linearity over long periods of time. Again, what we look for. ROIC, exceptional at 25%. This is a very, very profitable business. As you can see, remember, CGI was at 14%. That's because they're a little bit more capital intensive. Gartner is a pure play research firm, and that's why they're able to generate much higher returns on capital, because they don't have a lot of high capital expenditures that someone like CGI would have. Overall, it's a very capital light business. We'll talk about that in just a minute. Here's free cash flow conversion. Again, like CGI, well above 100%. That is excellent to see, especially sustained over a long period of time. Beautiful numbers here. And one of the reasons why Gartner is a great investment is because it actually has a very capital light business model. It is a research firm at its core. They also put on trade shows and events. But remember, these activities that they do, research, trade shows, events, they're not very capital intensive. It just takes renting out a convention center to hold these trade shows. And then the research is, all office driven. So it's, again, not a lot of IT infrastructure or other capital expenditures needed. So it's a very capital light business model, which basically means that it's a scalable business model, which means that they can grow revenue with very little incremental capital needed. That is very important. Why? Because if you can generate growth with little incremental capital needed, that means that you've got free cash flow growth. And when you have free cash flow growth, you can do share buybacks. And that's exactly what Gartner has done. Look at that, decrease in shares outstanding over time. This is an excellent use of capital, because, again, if you don't necessarily need to retain the capital to grow, because you can grow by scaling what your products and services already are without needing much capital, then you've got an increasing pile of free cash flow generating, which you can then return to shareholders, because you just don't need to retain that capital to grow. That's kind of the best combination that shareholders can really ask for. Growth without, much retained earnings needed. Meaning the company does not have to retain and reinvest cash flows to grow. It's growing because they can scale their products and services infinitely, kind of like a software company. So that's exactly what Gartner has been able to do, and that's why they've been able to return capital to shareholders in a very attractive way, just like this. So the Zacks Earning Certain proxy is a list of 76 such high quality businesses that exhibit these types of high quality characteristics. This is what we really do with this portfolio. We look deeply throughout the markets to find businesses that have these types of highly desirable characteristics. And these are some of the companies that we own in the portfolio: Novo Nordisk, Costco, Intercontinental Exchange, Mettler Toledo. These are pristine businesses with very high earnings linearity, very high durable earnings growth, with attractive returns on invested capital, and with excellent free cash flow conversion. All four of which have been sustained over many years of time. In many cases over 15 to 20 years time. So these are companies that are battle tested, time tested. They've had competition thrown at them. They've had recessions thrown at them. They've had strong dollar, weak dollar thrown at them. They've had high interest rates, low interest rates thrown at them. And despite all of this volatility from the macro side, despite all of the uncertainties thrown at them by competitors, they've continued to deliver high results. And when you have companies like that, chances are the probability tilts in your favor in terms of generating positive risk-adjusted returns over the long haul. And so investing in high-quality businesses like these and owning them for a very long period of time, allowing them to compound capital like that, and use free cash flow to buy back shares and pay increasing dividends, is the ultimate long-term investment methodology and philosophy, at least that we believe here at Zacks Professional Services. So this is kind of what their charts look like. We love these types of companies. We love to find them. We love to own them. And we love to hold them for very long periods of time. That's the core idea and principle behind the Earning Certain proxy investment strategy. So hope you found this helpful. Again, thank you for attending. I'd love to hear feedback from you. If you have any questions or comments, please send us an email at zrs@zacks.com, or if you are an Advisor Tools client, please send us an email at zat@zacks.com. And looking forward to seeing you guys again and attending future webinars. And again, please do reach out. I'd love to hear from you on any of this content that we've discussed here. Thanks, everyone. Talk to you soon.